Hello and good afternoon. Thanks for joining today's Market Color webinar. Before Jordi shares his thoughts, we would like to share our compliance department's thoughts, which are as follows. Weiss does not recommend any particular stocks, bonds, options, derivatives, or securities of any kind. We do not guarantee any results or investment returns based on the information you receive. Although we have used our best efforts to provide the most innovative trading and investment strategies, the views presented today are forward-looking statements which are subject to change as circumstances change, and we cannot promise future profitability. If you have any follow-up questions after listening to today's webinar, please feel free to reach out to Jordi and/or the marketing team with any questions. Weiss would love to hear from you. A replay of this webinar will also be available on our website and our YouTube channel later today. And with that, Jordi, the floor is yours.
All right, guys. All right, it's been a little while since I've done one of these, and now that we've finally had a correction, I wanted to kind of go through where we are and what I think is happening. I just want to set the context, because one of the things that's important to remember is we are still only a little over 6 months into a fairly historic time period, and we've seen dramatic shifts in asset prices, in the economy, and in earnings. And I think the point of today's is really to go through 4 different things to think about going into next year. One is just to kind of take you through the recent correction and put it in the perspective of probably something a little less emotional. Have an update on the economy and a very important shift that has been happening in spending, which I think is going to now become more important for people in setting up for next year. Third, I've done a lot of calls and have seen a lot of presentations over the last few weeks, and there's one theme that I think I disagree with everyone on, and I'll talk about it because if I'm right, I think there's an important inflection point. And then finally, really talking about the catalyst that I think is here for the end of the year, and it's not the election. So I just want to start quickly and kind of go through what happened over the last really 4 or 5 weeks. This is the S&P 500, and the first point I want to just highlight is this was kind of the bottom before the summertime, before we had a very, very large historic rally in the face of rising COVID cases. We just gave up during this September correction 62% of that gain. So this was a very, very big correction, and I don't think people realize how much it already has fallen. I happen to believe that we will go back to all-time highs over the course of the rest of this year, regardless of the outcome in the election. And I think most of that will occur leading into the election, which would probably be the biggest pain trade. One of the reasons, again, to look at that correction as having enough sell pressure, this is a 4-day, 5-day average of the down volume to up volume. And you can see over the course of this year during COVID, whenever we've seen kind of reach this 4 level, except for this one period in June, that has been a spot where we've hit enough selling pressure. And I think we reached that point last week. So even if we spend some more time down around the lows of last week, I don't think it's going far. And the reason is because of the next few charts. One is revisions. This is the 10-week average of, or the last 10 weeks average of earnings revisions. They continue to move higher. At the same time that earnings revisions are going higher, here's the new order category for the ISM. We've only had one period higher, which was in 2003, again, coming out of a long recession back then. New orders are still a leading indicator, and that means you should expect the ISM to continue to be up at higher levels. Also, we're now at a year-over-year M2, still making new highs up at 25%. Unprecedented, so you've got earnings going higher still, you have new orders going higher, and you have money supply going higher. Real income remains at the highest level in over 30 years. So you have people with money relative to inflation still up there. This is consumer net worth. We made an all-time high. We just got the Q2 data. So we're at all-time highs in consumer net worth. So incomes are high, money supply continues to grow, and at the same time, We have consumer net worth at all-time highs. And despite all of that, here is again the sentiment. I've showed this in almost every webinar since March. This is the AII net bull bear sentiment. We came in last week at -21. You can see that we broke down in late Feb, and we've been below zero for the entire time period, climbing a wall of worry, and sentiment remains at these levels. Here is the 30-week average of that, taking out the 09 level. And remember, this was the bottom of stocks in March of 09. The only time period we've seen lower than this was in the recession coming out of 1990, late 90. The abnormal situation of this is here's revisions relative to sentiment. Here is the PMI relative to sentiment over time. This one is the percent S&P above the 200-day moving average. So currently the S&P is about 10% above the 200-day moving average. So despite the fact that the economy has been growing and earnings have been growing and the S&P has been going higher, we haven't been able to get sentiment higher. These lines, these vertical lines you see there are the time periods where we've had a similar move of about 10% and where sentiment's been. And on average, we've been up in the 10 to 30 area on a positive number. We're in the -16 on this. This is a 20-week average for this. So you're not budging sentiment at this point at all, despite the fact we've had the price. Now, in terms of when the S&P typically peaks, we saw the S&P right now percent above the 200-day during this correction in September fall back fairly sharply. Again, that was an over 10% correction. But the new orders continue to go, new orders less inventories is up here. So you have still a lot of leading indicators which historically have been correlated to the S&P on a year-over-year basis, which suggests that the S&P is not done going higher, and we should continue to believe that we're going to see higher levels for it coming forward. This is the PMI relative to earnings revisions. Again, they're all locked up. So this is not just one category. You have the economy going higher and you have earnings going higher. And then at the same time, credit spreads barely budged during the month of September. So in a month where the S&P at one point was down over 9% from peak to trough and did fall from August down to the lows of 11%, credit spreads effectively were unchanged during the month. Now we're going to start getting into the thing that I mentioned, which is a shift in spending, which I happen to believe people are minimizing way too much. And this is the shift that is being caused for a variety of reasons. Some work from home, some urban flight in two of the major cities in terms of San Francisco and New York, and what has happened on the spending side. Now, I've shown this type of chart over the past few months. I still don't hear people talking about this as a structural change. So what I'm going to try to make an argument on is that this is a structural shift for a variety of reasons. This is the ratio of spending on durables to services. So obviously services collapsed because of the stay-at-home while people were still able to order some things, so you had durables going higher. But remember, this just started in the last 4 months. So we've seen the service side come back, but here's the durables. Durables are up past the highs. I've shown that the durable side is the most important to the S&P over history. And the reason for that is the durable side of the economy, particularly homes and autos, has a much bigger multiplier effect to it than anything on the service side. So with the durable spending way up here through the highs and the services still lagging, people keep believing this gap is going to narrow and people are going to go back to services over this. I do not see this happening over the course of the next year. I think this gap will remain. I think the housing market and the auto market are in a structural shift for the reasons that I brought up. This is the year-over-year change in durables. So we are at 12.9% or 12.6%. Basically, we're back at like 05, 04 type levels. But those came down sharply after that. I do not think we're going to see a big drop off here. I think there's a lot of pent up demand, and as I go through some of these charts, you're going to see it. This is the year over year in the service side, which is down 7%. So there's a lot of people expecting us to go back right into this range. I do not see that happening quickly. I do not see airline travel and experiential stuff coming back. Certainly not before we get through the spring. I do think from the spring to December next year will be when you start to see it come back. But I think there are some structural shifts that have occurred because of people being able to realize how much money was being wasted, as I always say on these, on some of the experiential side. This is new. New home sales. So we had a huge move up. This is the last 4 months. So the 4-month rate of change. This goes back to 1990. Looks like a large structural shift to me. It's met up by the household formations. We have a tremendous situation of millennials that have families that seem to be finally moving into housing and out of renting and out of cities. And most people seem to believe this will be temporary. I think this is a structural shift. There's been a lot of pent up demand on it. A lot of the housing analysts that have been around for the longest time have done great work on showing how there's pent up demand in there that should continue at least for the near term. This is PCE on the furniture and household spending, breaking through the highs. This is the home prices relative to the S&P. And again, we've had bounces along the way over this time period. Usually at this point, you're seeing rates move higher. Obviously, that's going to be a big part of this, which has not gone on. But the home builders have had a significant rally relative to the market, which basically says it's looking more structural there. If it wasn't, then we'd be seeing things that we're seeing in the energy side, where the stocks would still underperform. This is the rate of change. This is the last 6 months rate of change on the home builders. You can see we're above anything over the last 17 years. Still, even with the pullback, we hit 80% rolling rate of change. We're currently at 53%. So the stock market is saying that this is a sustainable thing and not just a one-off. This is the motor vehicles PCE, again, going through it. As people move out into more housing, as they want to have more control over their transportation, there's more houses being purchased or more autos being purchased right now. And it's showing up in the spending numbers. It's also showing up in used car prices. So this is the Manheim Used Vehicle Index. This is a 5-month average. You can see how far above we are anytime over the last 25 years. At the same time, we have non-defense capital goods shipments ex-air. So this is the durable goods report. This is the last 4 months. It's showing up in here as well. We continue to get large scale purchases of big things. I'm going to kind of shift a little bit here now into what this all means. This spending, and again, this is year-over-year income right here. The chart down here where we are, this is inventories. So this is retail sales inventories. The thing that's important here just to look at is where we are in inventories right now. So let's take a similar period back coming out of 09. This was October of 09. The difference is here, look where income was. Income was negative at the time, 3%. Right now we're positive 8%. So you have the spending going on and you have income, or you have income still up at high level, spending going on, but inventories remain very low. That's good for the forward-looking economy, but it also has implications for inflation as we go through this. This is the new order category relative to wholesale inventories. And the point here, this has moved about a year forward. So we have this right now is out to May of 2021, or about 9 months. There's a 9-month lead time. So you should see inventory builds, which is going to both help GDP. But I think the fact that we've had a lot of issues in keeping up with the supply chain, and it comes at a time where people have had to rebuild their supply chain, we have a chance here for more inflation. And this is showing it in terms of the Hong Kong to Los Angeles container rates. So this is the cost of shipping. You can see the spike here going back over the last 8 years where we have the data. This is a significant rise in terms of meeting the demand that is happening in the US. This is real 10-year yields. So this is the component of this where I said I disagreed with analysts. Most of you have seen presentations on real yields. We've seen real yields go lower. The driving factor for real yields going lower here, obviously rates have come down, but at the same time that 10-year rates have gone through the lows, we've had inflation break-evens go higher, which has driven real rates lower. Almost every strategist and analyst that the firm has had in here and I've spoken with, when I've said to them, what happens if real yields go lower, which is what I expect to see real yields go significantly lower, not because rates are going higher faster, or rates are going lower, but because I see inflation going up faster than rates. I do not see how 10-year yields can go up the way they normally would at this stage for a variety of reasons. And if that occurs, you're going to see a shift from what's happened over the last 10 years. And so I'm going to go through some charts just to highlight that this is showing up to me in a lot of data that people are choosing to ignore. The orange line here is the non-manufacturing prices paid. So this has gone up to levels which have been points in time where real yields were up at higher levels. Real yields are down here. So as inflation is going higher on the non-manufacturing side of the economy, the service side, non-manufacturing, we're up to levels that we were back in 2018. We have real yields lower. So something is happening here that's different than the past. We are not getting the move higher in rates. This is year over year personal income related to that same prices paid of the non-manufacturing side. So, and this is a 5-month average just to smooth and get rid of the noise. The main point is here, with income up at these high levels, I don't understand why more and more people don't realize that if you have that much more income, you should be able to pay more prices for things, particularly if there's shortages of them. And particularly if you're getting spending shifts away from vacations. You have more money, you've got lower expenses, and you're paying more prices for things. The ability to do this on the durable side is real. This is that prices paid versus 10-year yield. So this is the thing that is different. This matches up with the break evens. As of right now, the PCE deflator is not moving because it's slower to move, but we are seeing it on the more real-time indicators of inflation. This is it relative to PPI. So again, non-manufacturing prices paid relative to PPI going back to 02. PPI is down here, which means we're raising prices without having positive input costs at this stage. What's going to happen when input costs go higher? At the same time, you have this versus gas prices. So gas prices are lower across the pump. You're down about 15% from where you were a year ago, but prices paid are breaking away from what normally keeps inflation from going higher, which is gas prices. So we're still getting higher prices. This is it on the difference between PPI and CPI. So as we start to see PPI go higher, we're going to start to see CPI go higher, in my opinion, too, and the prices paid on the non-manufacturing. We're arguing for that. This is it versus the PCE deflator. So for the Fed, who's looking to get inflation up to the 2% level, which has been very difficult for them to do over the past 10 years, a lot of the indicators are saying there's a risk of this at a time when we've got negative real yields at this point. I think this is something people should be spending a lot more time on. And as I segue into this part, this is to kind of use some real-time indicators for me that I've shown in the past. The green line here is my risk row index. And just as a reminder, this has in it commodities, stock prices, and a weaker dollar. So as the dollar is getting weaker, as commodity prices are going higher and stocks are going higher, all three of those components end up with sorry, that's the white line. The green line here is the PMI. So you've got the white line sitting up here. We've had a huge move. We're up to the top end of the range for the last 10 years. And as I want to show you as we go through this, this has a lot of implications if we can break out of this. This is it versus earnings revisions on a global basis. So the importance of watching this risk row index relative to earnings revisions. This is it relative to inflation. So this is the PCE deflator again. So this is saying that unless something changes, you should expect the inflation numbers to go higher. And I do think we're certainly going to get up into here. If stocks continue to move higher, which I think will, I think commodities will continue to move higher, and I think the dollar will continue to be weaker as we go into the next year. With those in place, you will see inflation start to move higher. And the market is not priced for inflation to move higher or for real yields to go lower, driven by inflation. This is it. This is that growth index versus 10-year yield. So again, the number one thing that's happened, having lived in Brazil, this looks like a peg currency. So we've got rates sitting at peg levels, and I think that should be something that people are thinking about when they're going through their forecast for next year on the way to position. This is it versus break evens. So we may not be seeing it in rates, but break evens have been following this risk row index. So we've got, that's what is driving real yields lower, has been the move higher in break evens at this point. And getting back to that category, here's the relationship of that risk row index to the housing market. So this is home building stocks relative to the S&P. So if we continue to see a housing market where we keep seeing home purchases the way that they're going, you will continue to see the home building stocks be able to outperform the market. This would be a structural shift from 2009 on after the great financial crisis. The housing market matters a lot to all of these things, and particularly to inflation. Again, this is year-over-year income relative to the PCE deflator. So income is sitting up here as we go through the election. There's still a lot of talk of trying to make sure that we are actually getting more income into the hands of people at the lower end of the income scale. At the same time, the housing market helps dramatically more than the stock market. We did not see a dramatic move higher in stock prices from 2010 to 2020, but if we do see continuous prices moving higher of housing, as well as having record low mortgage rates, you're going to have refi activity, and this will benefit the parts of the economy that I think have been lagging over the course of the last 10 years. This is that risk-grow index relative to real rates. So this is the whole thing for me, is the difference in my opinion over what's going to happen is I continue to believe the white line will go higher. I think real yields will go lower. So this gap that exists right now, I actually think is going to worsen. And I do not think the same winners that have won over the last 10 years will be the winners. And I think you've already started to see that dynamic shift. Here's one place that is showing it in the market right now. Again, that's important. This is the transportation index X the air. I created an index, which is the white line. It has the rail stocks, the trucking stocks, and the air freight shipping stocks. It takes out the airlines. So without the airlines, you're seeing a dramatic move higher. And this will be the durable side of the economy over the experiential side. That continues to move. This is cyclicals versus defense versus that transportation X air. So you are seeing it. If we're going to see real yields move lower, I would think that cyclicals will continue to outperform defensives as part of an inflation hedge, rather than what has traditionally helped defensives, which has been lower, moving lower yields. I think if inflation is going higher, you'll see the cyclicals be the biggest beneficiary. And again, this is cyclicals over defense relative, again, to that negative yield chart. This is all of them together. So this has a small cap versus large cap, has real 10-year yields down here, and then you have that transportation X air. The point I'm making with this is you've seen small caps underperform large caps, and one of the driving factors has been real rates. There's a shift happening in real rates where the inflation side is driving real rates at this point rather than the rate side. And if we continue to get that dynamic where we have a pegged rate side, but a floating and volatile inflation side, I think you want to have protection, and people are going to need to have protections. This is another thing that gives me confidence, which is the ADXY, the Asian currency basket, and the CRB. I created this as one. They're moving up together. Cyclicals versus defense is the other one. More confirmation that at this point, we're getting more and more movement into the inflation side. And I think that continues. And I'll finish it off with this. I've shown this chart a bunch of times. It's continued to go. And this is the catalyst that I think is the most important. I do not think the election is an important catalyst for the market as much as people think. With earnings going the way they are and with the economy growing at the pace it is, I see this as a far bigger thing. Unless we have a dramatic shift in the decision making, which I think is highly unlikely, and a contested election that is far worse than even the worst outcome I've heard described, I think what the most important catalyst is the earnings. We had a pull forward for sure in Q2. We've only had one earnings report to focus on since we've seen the rally and the change in the market with the money printing. We are getting our second one now. I think as people go through and they see the surprises on the pricing power for some of these industrial related situations, and at the same time they have to reprice in a pull forward for tech, I think it has big implications for the valuation. This is the valuation gap that exists in the market. As it has gone higher, I've looked for this to mean revert for some time, as many people have. I think the catalyst is coming now, and I think you should focus a lot going into next year on a market that goes higher, commodity prices that stay bid, a dollar that stays weaker, and how you're positioned in your portfolio for that type of scenario of negative real rates getting worse. That's it for today. It was a little longer than normal, but it's been a long time since I did something. So I'll get back to you guys the next time something's going on.
That concludes today's webinar. Thank you for watching.